Welcome to the Deep Dive. We gather the sources, sort the data, and deliver the essential intelligence you need, fast and thoroughly.
Glad to be here.
Today, we're taking a deep dive into a real standout in the Nordic insurance world. Gjensidige Forsikring ASA, that's GJF.OL, on the Oslo Exchange.
Yeah, GJF, they're often called a powerhouse, and for good reason.
Definitely. And what we're seeing lately is, well, analysts are calling it exceptionally strong operational performance, a real turnaround, pushing them to peak profitability.
Exactly, which of course leads to that premium valuation they're commanding right now. It's, pretty high compared to others in the European P&C space.
Which brings us to our mission today. We need to figure out what specific, unique factor is driving this incredible success. And crucially, is that sky-high valuation actually sustainable? Can they keep this up?
It's the key question. And if you really boil down the whole investment case for Gjensidige, it comes down to one thing: pricing power. Real durable pricing power.
Pricing power. In insurance. That sounds almost counterintuitive. It's usually seen as such a commodity business.
Well, usually it is. Most insurers try to raise prices too much. Customers just shop around, find someone cheaper. Simple as that.
Right.
But GJF has shown, time and again, they can push through some pretty aggressive price hikes, especially in Norway, and they don't see this mass exodus of customers.
Okay, hold on. How does that work? In a mature market like the Nordics, full of competitors, they raise prices, people just stay.
It seems weird, right? But it comes back to this unique structural feature they have, something their competitors just don't. And honestly, it explains pretty much everything about their recent performance.
Okay, you've got my attention. Let's get into that structure. What is this moat?
All right, so first off, GJF is primarily a property and casualty insurer, P&C,
Yeah, home, auto, business insurance.
Yeah.
The standard stuff.
Exactly. Bread and butter. And they absolutely dominate in Norway, their home market. We're talking roughly 26% market share there. They do have some pension and savings stuff too, but the P&C, especially in Norway, is the engine.
Okay, 26% is solid. But lots of companies have strong home markets. What makes GJF different?
It's the ownership. This is the key. The majority owner isn't some typical investment fund or pension plan. It's an entity called the Gjensidige Foundation, Gjensidige Forsikring in Norwegian.
A Gjensidige Foundation, okay.
Yeah. And this foundation holds around 62% of GJF's shares. But here's the critical part. Its whole purpose, its mandate, is tied directly to the customers. The Norwegian customers.
I think I remember reading about this. It goes back to their history, right? Weren't they originally a mutual company owned by the policyholders?
Exactly. Spot on. When GJF went public back in 2010, they set up this foundation specifically to preserve some of those benefits of the old mutual structure for the Norwegian customers who were policyholders then. It's like a legacy keeper.
So the foundation acts in the interest of the customers.
Yeah.
How? What does that actually mean in practice?
It means cash back. They have this incredibly powerful mechanism called the customer dividend mechanism. Think about it. The foundation owns 62% of the company, so every year it gets this massive dividend check from GJF.
Right, like any major shareholder would.
But instead of just banking it, the foundation turns around and distributes its share of the dividend directly back to GJF's non-life insurance customers in Norway.
Wait, so if I have my car or home insured with GJF in Norway, I literally get a check in the mail or a deposit from their biggest shareholder.
That's exactly it. A cash rebate every year. It's not just some theoretical loyalty program. It's actual money hitting their accounts.
Wow, that sounds significant. What kind of numbers are we talking about?
Oh, it's huge. In 2024 alone, the foundation handed out NOK 2.5 billion. That's a lot of krona. And since the IPO in 2010, the total figure is around NOK 30 billion returned this way.
30 billion Norwegian kroner? That's got to build some serious loyalty.
It absolutely does. Because think about the effect. It effectively lowers the customer's net cost of insurance.
Okay, explain that. How does the net cost work?
Well, GJF might announce a premium increase, right? Like everyone else does, especially lately. But the customer, knowing they're likely getting this cash dividend back later in the year from the foundation, factors that rebate into their calculation.
I see. So the sticker price might be higher than a competitor's, but once you account for the expected dividend, GJF's actual cost to the customer is lower.
Precisely. It means GJF can lead the market on price increases, charge a higher gross premium, but still remain competitive or even cheaper on a net basis for these core Norwegian customers.
And the proof is in the pudding, I guess. What are their retention rates like?
Exceptionally high. We're talking 90% to 92% retention rates consistently. That's way, way above what you'd normally see in this industry. Customers just don't leave.
So if I'm a competitor,
Mm.
like Trig or if P&C, I can try to undercut GJF's list price by, say, 5%, but I still can't actually match their effective price for the customer because of this dividend kickback,
You got it. It's a structural asymmetric advantage. They just can't replicate it.
which creates this,
Yeah.
what did you call it, a virtuous cycle.
Yeah, exactly. A virtuous cycle. GJF makes good underwriting profits partly because they can price effectively. Those profits fuel big corporate dividends. The foundation gets its huge slice, gives it back to customers, which locks in their loyalty.
Which then allows GJF to keep pricing effectively, even raising prices when needed, without losing those customers. And the cycle starts again.
That's the loop. It effectively insulates their core Norwegian business from the brutal price competition you see elsewhere in P&C.
So when we're looking at GJF's balance sheet, the most valuable things aren't even listed as assets, are they?
Not in the traditional accounting sense, no. I mean, the capital's there, the investments are there, but the real unrecognized assets, the things that drive the value, it's that brand reputation fueled by decades of history. It's that incredibly deep, structurally reinforced customer loyalty, and it's this unique competitive moat created by the foundation's dividend mechanism. That's the intangible gold.
Okay, so they have this incredible foundation of loyalty. And that loyalty must have been put to the ultimate test recently, right? Between, say, 2022 and early 2024.
Oh, absolutely. That period was brutal for P&C insurers globally. We saw rampant claims inflation. The cost of everything just exploded.
Yeah, car parts, construction materials, labor for repairs, it all went through the roof.
Exactly. Claims costs were hammering loss ratios everywhere. But here's where GJF really showed the power of its moat. They didn't just absorb the costs or try to tread water.
What do they do?
They went on the offensive. They used that loyalty buffer to implement some seriously aggressive price increases across their key segments, especially Norwegian motor and property insurance.
Aggressive how? Do we have numbers on that?
We certainly do. Take their Norwegian private motor business. By the end of Q1 2025, the average premium written was up a staggering 17.4% compared to the year before.
17% year over year.
Wow. And they weren't even done. Management indicated that forward pricing, the new rates being applied from April 2025 onwards, were set even higher, pushing towards 19.5% increases.
Okay, nearly 20% price hikes. That's bold. But what about the other side of the equation, the claims inflation itself? Were costs rising that fast too?
Well, that's the crucial part. Management's own forecast for how much their motor claims costs would actually increase was much more moderate. They were modeling something in the range of maybe 4% to 7% for the coming period.
Hang on, so prices going up almost 20%, but the underlying costs expected to rise maybe 7% at the high end?
Yep. You see the gap.
Yeah, that's a massive difference, more than 12 percentage points.
Exactly. That's what analysts call the price-cost gap. And that gap represents pure potential margin expansion flowing straight to the bottom line as those new, higher prices earn through on policies.
So they use the loyalty moat to push through price hikes, far exceeding their actual cost increases.
That's the story. And that is the direct cause of the incredible improvement we saw in their key profitability metric, the combined ratio.
Right, the combined ratio. Let's quickly define that again for everyone. It's basically costs divided by premiums, right?
Yeah, simply put, it's the sum of the loss ratio, what they pay out in claims relative to premiums, and the expense ratio, their operating costs relative to premiums. You want that number below 100%.
Below 100 means you're making money just from the insurance itself before you even count investment income.
Correct. An underwriting profit.
And GJF's combined ratio. What happened there?
It was spectacular. For the full year 2023, it was 87.1%, which was already pretty good, frankly.
Decent, yeah.
But by the second quarter of 2025, it had fallen all the way down to 79.0%.
79%. That's incredibly low for P&C insurance, isn't it?
It's exceptional, truly best in class. Not just in the Nordics, but globally. Think about it. For every dollar in premium they took in, they were spending only 79 cents on claims and running the business.
Leaving 21 cents on the dollar is pure underwriting profit.
Exactly. You usually consider anything in the low 90s to be excellent for a major insurer. Below 80%. That's operating at peak efficiency. Definitely a cyclical high point for them.
And was this just the Norwegian powerhouse carrying the load, or did the improvements spread?
That's the encouraging part. While Norway was obviously strong, the improvement was actually quite broad-based. We saw progress even in their segments in Denmark and Sweden, places where they've historically been less profitable. Those areas are showing steady improvement too.
Which all feeds through to shareholder returns, I assume. How did the ROE look?
Predictably, it jumped significantly. Return on equity went from a solid 18.2% in 2023 up to 22.7% for 2024.
Strong acceleration.
But then, in Q2 2025, the annualized ROE hit a stunning 31.3%.
31% ROE. That's huge. That's far above any reasonable cost of equity. Massive value creation.
Absolutely. It confirms they really hit the sweet spot of the earnings cycle, powered almost entirely by their ability to aggressively manage that price-cost gap using their structural advantage.
Okay, so this incredibly profitable core business operates within the wider Nordic P&C market. Let's just quickly sketch that out. How big is it? What's it like?
It's a mature market, but still quite substantial, valued around, $39 billion back in 2022, and forecasts suggest it could grow steadily towards maybe $57 billion or so by 2029. So decent underlying growth.
In competition.
The key thing about the Nordic market is how concentrated it is. In places like Norway, Sweden, Finland, you typically see the top 4 insurers controlling a huge chunk of the market, often 70% to 90%.
High barriers to entry, I imagine.
Very high.
Yeah.
You need immense scale to compete on costs, you need a brand people recognize and trust, and you need a ton of regulatory capital. GJF obviously ticks all those boxes, especially in Norway.
Right, where they have that leading 26% share.
Mm-hmm.
But you mentioned Denmark and Sweden earlier. They're not dominant there.
No, much smaller. In Denmark, for instance, their market share is more like 7.3%. So outside Norway, they're definitely more of a challenger.
Which means their strategy has to be kind of two-pronged. Defend the fortress in Norway, but find efficient ways to grow elsewhere.
Exactly. And that really explains a key move they made in 2024, selling off their Baltic operations, ADB Gjensidige.
Ah, right. They exited the Baltics. Why?
It was all about simplification and focus. Management basically decided, look, let's concentrate our firepower, our capital, our management attention on the core Nordic region where we make the most money and have the biggest advantages.
Get rid of the distractions, focus on the high-return core. Makes sense.
And what was really telling was that even after selling the Baltic business, they kept their ambitious financial targets for 2026 completely unchanged.
Implying they're super confident the Nordic engine can more than make up for it.
Pretty much. Either the Baltics weren't contributing much profit anyway, or they see that much upside in the Nordics, especially Denmark.
Okay, so Denmark is the main focus for growth outside Norway. How are they tackling that?
Strategically, they're not just trying to grow organically policy by policy, which is slow and expensive. They made a significant move with the acquisition of PenSam Forsikring in 2024.
PenSam. That came with a partnership deal too, didn't it?
Yes, a long-term distribution partnership. That was the clever part. The acquisition itself was a nice bolt-on, but the partnership gave them immediate access to PenSam's nearly 500,000 members.
500,000 potential customers right there. That's a quick way to boost scale and market presence in Denmark.
Definitely. And to make sure they actually capture the benefits of that increased scale and improve profitability in Denmark generally, they undertook a major internal shakeup in July 2023. The Nordic reorganization.
What did that involve? Just moving nameplates on doors?
No, it was quite structural. They effectively merged the Norwegian and Danish operations into unified cross-border divisions. So you now have one private division covering both countries, one commercial division, one claims division.
Good. Breaking down the country silos, what's the goal there? Just cost savings?
Cost savings are part of it, sure. Driving operational efficiency, eliminating duplicated functions. But it's also crucially about exporting best practices.
Taking what works so well in Norway, the underwriting discipline, the efficient claims handling, and applying it directly to the Danish business.
Exactly. The ultimate aim is to lift the Danish combined ratio, which has historically lagged Norway's, much closer to that stellar Norwegian level. That would provide a significant boost to overall group profitability.
And are we seeing signs that it's working?
Early days, but the overall group combined ratio improvement we discussed, including better results from Denmark, suggests that this integration and focus is starting to bear fruit.
Good. Now, looking ahead, you can't ignore technology and insurance these days. How important is that for GJF?
It's critical, especially for maintaining that low expense ratio, which is part of their edge. They're investing heavily in digitalization, automation, using AI, all the buzzwords, but for practical purposes.
Streamlining processes. Underwriting, claims.
Exactly, making everything faster, cheaper, more efficient. Technology is absolutely fundamental if they want to maintain their cost advantage particularly over smaller rivals who can't afford the same level of investment.
And we saw some concrete steps there too, right? Like the tie to every partnership renewal.
Yeah, in May 2024, that deal was explicitly focused on modernizing their core IT infrastructure, moving more systems to the cloud, stabilizing things. It's the necessary plumbing upgrade.
And does this tech investment also enable new products, making them stickier?
It does. They're not just relying on the dividend for loyalty, they're launching value-added services. Things like integrating home alarms directly with insurance packages, offering specialized cyber insurance for small and medium businesses in Norway. These things deepen the relationship, make the premium feel more justified.
Okay, so we've got the unique moat driving underwriting excellence and a clear strategy for focus and growth. But none of that works without a solid financial foundation, right? How strong is GJF's balance sheet?
Rock solid, extremely well capitalized. The key metric here for European insurers is the Solvency II-3 ratio.
Right, the capital adequacy measure.
And in Q2 2025, GJF reported a Solvency II-2 ratio of 182%.
182%. How does that compare to requirements?
It's comfortably, very comfortably above both the regulatory minimums and what we understand their own internal targets to be. It gives them a really significant buffer.
Why is that buffer so important for a P&C insurer? Is it just about surviving a bad year?
It's exactly about that. It provides resilience. If they get hit by a massive storm, like Storm Hans in 2023, or just a string of large losses, they have the capital cushion to absorb it without having to panic. They don't need to suddenly raise expensive capital or slash their dividend just because of a temporary spike in claims.
So it ensures stability through the cycle.
Precisely. And this strength is recognized externally, too. They have an A credit rating from S&P, which is solid, and they manage their debt very conservatively. Their debt-to-equity ratio is only around 22%, not loading up on leverage.
Okay, strong balance sheet. Now, insurance companies have two ways to make money. Underwriting profit, which we've covered.
And investment income. The second earnings engine, as some call it.
Right. How does GJF's investment portfolio look? Is it adding stability or risk?
It's definitely geared towards stability. The portfolio is pretty large, about NOK 61.6 billion as of the first quarter 2025. But the key is its profile. It's managed very conservatively.
Meaning mostly safe stuff, bonds.
Yeah, around 83% of it is invested in high-quality investment-grade securities. They're not chasing risky returns in the equity markets or with junk bonds. It reflects their focus on capital preservation.
Now, we've been hearing for years how rising interest rates are bad for bond portfolios. But for an insurer like GJF, constantly getting new premium cash, has the recent rate environment actually been good?
Absolutely. It's been a significant tailwind for them.
Yeah.
Think about it. They have old bonds maturing that were bought when rates were near zero. And they have all this new cash coming in from premiums every day. Now they can reinvest all that money at much, much higher current market yields.
So the average return they're getting on their fixed income portfolio is steadily climbing.
Exactly. It directly increases the running yield of the portfolio. Each bond that matures and gets replaced, each new premium invested, locks in a higher return than before.
And what does that mean for earnings?
It means that second engine, the investment income, becomes larger and more predictable. It provides this growing, stable base layer of earnings underneath the potentially more volatile underwriting results. That's very attractive for income investors.
Speaking of income, dividends, GJF generates a lot of profit. How do they give it back to shareholders? What's their policy?
Their policy is very clear and very shareholder-friendly. They explicitly target a high and stable nominal dividend.
High and stable.
Okay. And the baseline is a payout ratio of at least 80% of their profit after tax. Plus, and this is important, they also commit to distributing any excess capital they build up above their target solvency range, often through special dividends.
So they're not letting cash pile up unnecessarily on the balance sheet.
Not at all. And we've seen this in action. For 2024, the total proposed dividend was NOK 10.000 per share. That was up nicely from NOK 8.75 the year before. And it represented basically a 100% payout of that year's profit.
Wow, pretty much paying out everything.
Which leads to an interesting point about how they return capital. It's almost entirely through cash dividends. You see very little in terms of share buybacks from GJF. Their buyback yield is negligible.
That's unusual. Many companies prefer buybacks, especially for tax reasons.
Right.
Why the focus on dividends at GJF? Is there a structural reason?
There is, and it ties right back to the moat. Remember the Gjensidige Foundation?
Yeah, the majority shareholder, that gives dividends back to customers.
Exactly. The foundation needs that corporate dividend payment from GJF in cash so it can fund its customer dividend program. That program runs on cash.
Ah. So if GJF did a massive buyback instead of paying a cash dividend, the foundation wouldn't get the cash it needs to pay the customers.
Precisely. A big buyback program would actually limit the foundation's ability to execute its core function, which underpins the whole loyalty mechanism.
So the high cash dividend policy isn't just management preference, it's structurally necessary because of the foundation's role.
You've got it. It reinforces the expectation for a high and stable cash payout for all shareholders, not just the foundation. It's baked into the system.
Okay, let's recap. We've got an incredibly high-quality insurer, super profitable, two strong earnings engines, underwriting and investments, and this unique defensible moat in its core market. Sounds great.
It is a very strong picture, yes.
Well, market knows this, right? Which brings us to the valuation. GJF stock isn't exactly cheap these days.
No, definitely not. It's trading at multi-year highs. The price-to-earnings ratio is up there, around 22.8x, but the really telling metric is the price-to-book ratio.
What's that looking like?
It's around 5.9x.
5.9 times book value. Wow. How does that compare historically for GJF?
Well, until this recent run-up started in maybe early 2024, GJF typically traded in a range of maybe 3.8 to 4.3x price to book, so 5.9x is significantly higher. It clearly shows the market has already priced in, or maybe even overpriced, the successful turnaround and the peak profitability we've been talking about.
And how does that 5.9x stack up against peers? Other Nordic insurers like Sampo or Tryg, or the big Europeans like Allianz or AXA?
It's at a premium to most of them, both on PE and PB. Sampo, for example, is closer to, say, 19.8x PE, so GJF is definitely getting top dollar valuation.
So the big question is, can that premium be justified? What's the argument for paying almost 6 times book value?
The argument rests entirely on quality and returns. The market is basically saying, yes, it's expensive, but you're paying for best-in-class performance. Look at the ROE. GJF's trailing ROE is over 27%, maybe even higher based on that Q2 annualized number.
Compared to?
We'll compare that to a peer like Top Denmark, maybe generating an ROE closer to 10%. Or look at the combined ratio GJF at 79.0% versus peers often struggling to stay below 95% or even 100% in tough years.
So the argument is you pay a premium price for premium sustainable performance enabled by that moat.
That's the bull case. You're paying 5.9 times book because that book value is currently generating incredibly high returns, close to that 31.3% annualized level we saw.
Okay, but no investment is risk-free, especially one trading at peak multiples. What are the bears saying? What are the key risks that could challenge this rosy picture and that high valuation?
The number one concern, without a doubt, is sustainability risk. Can they actually sustain this level of profitability?
Meaning, can that 79% combined ratio last?
Exactly. That amazing ratio was achieved by really pushing prices aggressively while claims inflation was also high. The big what if is, what happens when claims inflation cools down? Can GJF keep pushing prices up by double digits then? Probably not.
And what about competitors? They must have been hurting while GJF was thriving. Won't they fight back?
That's the other side of it. Competitors who lost money or market share during the inflation spike might get much more aggressive on pricing in, say, 2026 to win some business back. If that happens, GJF's margins could definitely get squeezed from these peak levels. Most analysts are already forecasting some moderation.
So peak earnings might already be in the rearview mirror or just about passing?
It's the primary risk. Beyond that, there's the inherent risk in P&C insurance. Catastrophe risk.
Big weather events, basically.
Yeah. Despite having reinsurance to cover large losses, a really major event, like Storm Hans in Norway in 2023, can still cause significant earnings volatility in a given quarter or year. These are getting harder to predict and potentially more severe.
Which links to the longer-term issue of climate change, I suppose.
Absolutely. More frequent and severe floods, storms, droughts. This is a fundamental physical risk for property insurers. GJF has to constantly update its pricing models for these risks, buy more reinsurance potentially. It's an ongoing challenge and a potential drag on long-term profitability if not managed perfectly.
Okay, those are external risks. What about internal ones? Things they need to get right themselves.
The big one there is execution risk, particularly around Denmark.
Making that Danish expansion actually work and deliver the promised profitability.
Exactly. Integrating PenSam smoothly, realizing those synergies from the Nordic reorganization, lifting the Danish combined ratio. It all sounds good on paper, but they have to deliver. If the Danish business continues to lag Norway significantly, it undermines the growth story and management's credibility.
Any other risks?
Yeah.
Regulatory.
Always a factor. Regulatory risk. Changes to solvency thesta rules, for example, could impact their capital requirements, how much they can pay out in dividends, or local regulators could impose new constraints. It's usually a lower probability risk, but it's always there in the background for financial institutions.
Got it. And just quickly, are there any areas where we as analysts wish we had a bit more data from the company? Any information gaps?
Yeah, a couple of minor ones. It would be helpful to have a more granular breakdown of their investment portfolio, things like the exact duration of their bond holdings, a detailed credit risk split. That would allow for more precise modeling of how sensitive their investment income is to interest rate changes.
Okay. And anything else?
The other thing is, while we know their solvency CISIC ratio is very high, 182%, management doesn't publicly state their specific target range for that ratio. Like saying, our optimal range is 150% to 170%.
Why does that matter?
Because without knowing their precise target, it's harder to predict exactly how much capital they consider truly excess, and therefore likely to be paid out as special dividends in the future. It adds a small layer of uncertainty to predicting future capital returns.
All right, let's try and pull this all together. What's the final takeaway on Gjensidige Forsikring?
I think it's clear GJF is a genuinely high-quality company. It's a highly efficient, very profitable insurer. It's got that incredibly strong, defensible position in its core Norwegian market, thanks to that unique customer dividend structure from the foundation. That's the heart of it.
And the earnings seem solid, too, not just accounting profits.
Yeah, their reported net income tracks pretty well with the actual cash they generate from operations, and it's not a business that needs to constantly reinvest huge amounts back into itself. CapEx is pretty low relative to cash flow, so that operating cash is genuinely available to be returned to shareholders.
And they certainly capitalized on the recent inflationary environment with that aggressive repricing strategy, leading to that amazing 79% combined ratio in Q2 '25 that used the moat perfectly.
They absolutely did. They widened that price-cost gap better than anyone, and the market clearly recognized that execution, hence the premium valuation.
Which leads us nicely into our final provocative thought for you, our listeners, to chew on.
Right, so that 79% combined ratio, it's fantastic, but it was achieved in a very specific environment, right? An environment where massive price hikes were possible, even necessary, because underlying costs were also soaring. The insurance cycle always turns.
Always does.
So the question you really need to wrestle with is this. When things inevitably cool down, when pushing through 15–20% price increases is no longer feasible or justifiable, what happens to that margin?
Can the structural advantage, that customer dividend moat alone, keep the combined ratio down near 80%?
Or are these current peak margins fundamentally unsustainable over the longer term? Are we guaranteed to see an eventual, maybe gradual, maybe faster haircut back towards a more normalized level, perhaps in the mid-80s?
And if that happens, what does it mean for a stock trading at nearly 6 times book value today? Can that premium hold if the ROE starts to drift back down from 30% towards, say, 20%?
That's the core tension. How much of this peak performance is cyclical and how much is truly sustainable thanks to the structure? That's what you need to watch in their upcoming results.
How long can perfection or near perfection last? A great question to ponder.
Indeed, a perfect place to wrap up this deep dive.
Thanks for diving deep with us today. We'll catch you on the next one.